So in this unit, we'll first define what financial accounting is, its purpose. We'll look at the types of organizations and also the users of financial accounting information. So to start with, we are going to define financial accounting simply as a classification, recording of monetary transactions of an entity in accordance with the concepts, principles, accounting standards, and also the legal requirement of their representation. So financial accounting, unlike management accounting, follows accounting standards and principles that are laid down. So we have accounting standard 1, 2, we have prescribed standards that a financial accountant must follow. Unlike management accounting, this one has standards that are stipulated. So the purpose of financial accounting. So we want to understand the key purpose of financial accounting. To start with, accounting information is required for a variety of reasons. Number 1, to fulfill the legal requirements. Number 2, to assist managers to plan and control. So accounting information is of interest not only to the businesses themselves, but there are also other users. And this will be later on discussed in terms of the internal and external users of accounting information. So we also have different types of business entities that exist, starting with the sole trader, partnership, cooperatives, and companies. So under the Companies Act, that is what guides the companies that come into existence. The partnership has also an act of 1980, which has an agreement or a deed that also governs what partners must do and their requirements. So we have a sole trader, a partnership, a company, and a cooperative. All these ones have different forms and requirements. So to start with, the sole traders represent ownership of a business entity. So the main characteristics of a sole trader are as follows. 1 individual owns a whole entity. The owner is usually the main source of finance. Of course, he plays a key role, but he could employ a few workers. So a sole trader can have employees. The main disadvantages is that the business dies alongside with the owner. So there's no assured continuity. And also there's a limited pool of resources that the sole trader can access his or her funds from. So these are the advantages and disadvantages of a sole trader. When we go to a partnership, it is similar to a sole trader, except that here you must have at least 2 owners of a business, and a partnership will often grow or outgrow a sole trader. The limitations of a sole trader are now at least amplified here. So it is quite common for people to merge to form a partnership from about 2 to 20. Examples could include law firms, accountants. So in a sole trader, there's no governing agreement, but in a partnership, there's what is called a partnership deed that stipulates how much each share must have, the amount of profits to be shared, the salaries for the active partners that will be given to them. So that is what is called a partnership deed. So it has its own advantages and disadvantages. The advantages are that there's a larger pool of resource and expertise. There's also partnership also has advantages that decision making can be quality because you get to discuss and brainstorm on the decision that will be brought on board. The disadvantages could be that it is prone to clashes and fights that may come through because of disagreements. Also, it has unlimited liability, meaning the personal assets or property of the actual partners can be touched. That is a disadvantage of a partnership. So when partnerships are formed, they come up with an agreement, which is a partnership deed, which talks about how much money they should put, what jobs they should do, how many hours they should work, and the profits, how much profits must be shared. So in the absence of this agreement, courts will deduce or will stipulate their standard requirements that are given. So as I explained, the advantages of partnership, there's a pool of resource and skill. Risk sharing is high. You are sharing the risk, and there's no need for auditing or publicizing your financial statements annually. As well, this kind of company or business structure is not regulated. It's easy to raise capital. Disadvantages are that you have unlimited liability. There's a dependence on partners for capital, and when a partner joins or dies, you need to dissolve the partnership to start afresh. And owners of the partnership can be treated as one and the same. So if one makes a wrong decision, it becomes binding to everyone else. So it's not easy to sell a partnership. Then we go to a company, which is regulated by the Companies Act. In the company, there's what is called separate legal entity, which separates the owners of the business from the business itself. So consequently, it means that the liabilities of the company cannot be extended to the shareholders themselves. That's what it means to be limited liability, meaning the owners of the business who are the shareholders are limited to the amount that they themselves have invested in the company. So what is a company? A company is simply a legal entity that has a personality of its own. It is a person its own that can sue and be sued. It owns property and enjoys the benefits of a person. It acts through what we call a board of directors who report to the shareholders. So partnerships are subdivided into two. There's a public and a private company. Private company can be limited, but formed by a family or small persons within. They are not allowed to trade their shares on the stock exchange, and these ones can sell their shares publicly, privately, whereas a public company can trade shares on the Lusaka Stock Exchange or any stock exchange, generally if it's not in Zambia. So private are registered by individuals other than the public. So its name ends with limited or LTD. For a public, it is PLC. So there's a minimum number of directors and shareholders who are required for a private company. So private companies do not invite the public to buy their shares. For the public, like I said, they can trade on the stock exchange. It ends with PLC. So they are also limited by how much they themselves invest in the business. So an example of a structure is given. So the shares could be sold, and ownership in a company is by shares, and the return on the shares are called dividends. So the advantages of having a company is that one, you have what? Limited liability. Two, it is easier to finance from the shareholders themselves, and there's no limit number of people or shareholders who could buy. So it's a separate legal entity from its owners. There are also tax advantages to being limited, having limited liability, meaning you have a lower rate for individuals. It's shared amongst them. Lastly, it is easy to transfer shares from one to another. So when you decide to sell your shares, you can still just auction them, sell them at the stock exchange. The disadvantage is that you are required to be audited at a cost and publicly disclose your financial information, which means your competitors and even bad people could have access to your information and see how you're doing and re-strategize for or against you. Limited companies also have to comply to accounting requirements. Finally, issue of share issues are regulated by law. For instance, it's difficult to reduce the capital share. So we also have users of financial accounting information who could be internal or external. So internal users are those ones within the business, starting from managers, directors, internal auditors, employees. External users start from the lenders, government, local authorities, analysts, journalists, competitors, suppliers, external auditors, customers, general public, and also trade unions and potential investors. So these ones are users of financial accounting information. So for the external users, we have shareholders who are the actual owners of the business. They need to be sure that what they've invested in will give the company a foreseeable future. All right. So it gives the current, they need information to show the current and future profits and security of their investment could be reviewed by the strength and solvency of the company. So this is why they're so keen in wanting to know this financial accounting information. Then the potential investors, same as above. We have employees who want to know if their employment could be secured, or also they could bargain for pay rises. Trade unions are also keen to this information because they want to use it for bargaining purposes. So take note of these two. The customers, they need to know that the company can continue to supply them into the future, especially that customers are dependent on company for supplies. So they want to know that this company is able to sustain our demands. So customers are really keen to having this financial information. So suppliers also need to know if they'll be paid should they supply. Competitors, on the other hand, would want to use this information to make economic decisions, and government agencies will plan how the economy is performing using financial information. Managers, on the other hand, will use this information to plan, control, and also manage a company. The board of directors need this information for strategy, development, and governance. Banks and lenders want to know if their money will be repaid. Journalists, on the other hand, for news and the general public, would want to know in terms of social corporate responsibility. So these are the users of financial accounting information. So when we get to the definition of accounting, is simply the classification, recording of monetary transactions of entities in accordance with established concepts and principles. Then when we go to management accounting, it is defined as a process of what? Identifying, measuring, accumulating, analyzing, preparing, interpreting, communicating of information used by management to plan, evaluate, control an entity, and also to assure appropriate use of and accountability of its resources. So this is basically for internal use. So this is a definition of management accounting. It's mainly concerned with what? Using financial data and communicating it for management purposes. So financial accounting and management accounting can be differentiated as has been defined. Quickly, we can go to some quiz questions based on what we have just explained. So number one, we're being asked, customers, amongst the users of financial information, what are they primarily interested in? Timely payment of supplies, working conditions of employees, going concern of entity, how the entity will be financed. So we said they want the going concern so they know whether they'll be supplied perpetually. Then which of the following are external users of accounting information? We talked about them. That on the external users, we have what? Shareholders. We also had what? Journalists. We also had who? Quickly, who are the external users of financial accounting information? We also had government. Internal users, we had directors, employees, managers. So which of the following are external users? It is shareholders. All right. Then which of the following statement best defines management accounting? So we defined it as a process of measurement, accumulation, analysis, presentation, communicating of information by management to plan, evaluate, control within an entity, appropriate use of accountability. So this is just a definition we are just from reading. So this is the definition of management accounting. So which user is interested in the current and future profits, security of the investment, which can be reviewed by financial strength and solvency of the company as shown in the financial position. So we talked about the shareholders. They're really keen about looking at the security of the investment. Employees, maybe we discussed to fortify this. Why are employees keen to financial accounting information? These ones are more concerned about what? Security of their wages. Then trade unions for bargaining purposes, and the local communities, what are they interested in? Corporate social responsibility. Then when we go to the fifth question, we're being asked which of the following statement is true about sole traders. They don't have employees. This is a lie. They do have employees. They need to publish their financial statements. Only a company can do that. We're also told that it is owned by one person. This is true. Sole traders are financed only by the owner. No, they could even be financed by friends. All right. Next question, which one of the following is not an example of partnerships? Okay. One, an unlimited company. This one is not. A law firm. This one is. Accountancy practice. This one is. A private university. This one is not. So 1 and 4 are not. These ones are not examples of what? Partnerships. Then when partnerships are formed, it is not imperative to have an agreement regarding. So when partnerships are formed, the agreement will show how the profits should be shared, yes. What jobs each partner must do, yes. How much each partner must put in the business, yes. How many hours they should work, yes, but not limited liability of the partnership. So E is the correct answer. Advantage of limited liability is that 1, it is difficult to reduce share capital. No. There is need to publicize and disclose information. No. There is limited liability for the shareholders. Yes. The others are not correct. Then finally, which of the following is not a purpose of accounting? So accounting is to enable users to know what entity owes the other parties. Yes. To enable users ascertain how entity performed over a specific period of time. Yes. To provide information to non-users of financial accounting to enable them make decisions. No. This one is to provide information to users of accounting to make decisions. So this one is not a purpose of accounting. To enable users ascertain what the entity owns at a particular time. Yes. To also ascertain what the entity is owed by other parties. Yes. The liabilities, and also to enable the users to ascertain how the entity is financed. Yes. So this is how you're supposed to answer this.